There's no recession in sight, says Anastasia. Looking forward to reacting to that one. That should be a fun one to react to here, folks. Brad Gerstner just went on CNBC a few hours ago, spoke about tech stocks and how he's feeling in regards to money that's going to rotate into big tech. Looking forward to reacting to that one. 3-stock lunch, Goldman Sachs, NVIDIA, Toll Brothers. 3 stocks that are actually all interesting to me, so looking forward to getting into that one. And the last one up here, a few hours ago, Goldman Sachs CEO David Solomon spoke about his views on the economy. I think he's, my opinion, he's probably the second most important person in banking. The only person I'd put above him is Jamie Dimon at obviously JP Morgan. And then after it, David Solomon at Goldman Sachs is next most important. So we'll speak about that. I want to react to that, give my opinion and perspectives there. Appreciate y'all joining me as always. I have a question for you guys, okay? Love to see you guys in the comment section. How many of you guys have reached 6 figures now in your portfolio? If you've reached 6 figures in your portfolio and you feel comfortable sharing, let me know in the comments section. Just say something like, I've already hit 6 figures, or I've already reached that milestone, something like that. If you haven't hit 6 figures, also let me know if you're on your path, if you're on the way to reaching 6 figures. I would love to hear from you guys. I'm just always curious, kind of where everybody's at and those sorts of things. I have a brand new workshop for you guys. Make sure you check that out at some point. That will be pinned comment down there for access to that. I recorded it last week for you guys. It's a video that goes into stocks to buy now for 2025, how to position your portfolio now for 2025. It can be very helpful to you. That's pinned comment down there. Let's get into this.
Good to see you.
Good morning,
in the
Good
studio.
Morning.
Inflation ever worry you anymore, or we've definitely shifted to growth concerns?
It seems like it's not the one that matters anymore.
Sure.
I mean, we are expecting an inline print of 3.2% core CPI, and I think that's good enough. I mean, importantly, we do see the 3 months annualized inflation that's coming down quite significantly, more so than the 6 months number. So I think that should provide support for the case for the Fed to cut interest rates. But you're right, Joe, it's not about inflation anymore. It's more about the growth concerns. And, so far, what's unnerved the markets in this first week of September is that we're once again on the recession watch and the recession obsession, as I call it, only because the labor market seems to be weakening more than expected. So that's the driver in the markets right now. Personally, I don't subscribe to the view that we are headed for a recession. I think this economy is slowing, but it is still growing. And outside of the unemployment rate, you look at the range of economic indicators, and they're not implying high odds of a recession.
In all due respect to Anastasia here, I think that's a bad view. I really do. I think that's a bad take. I think there's absolutely a recession in sight. That does not mean, the way to think about it is, picture you're out on a lake, okay, and it's a sunny day, and then all of a sudden you start to see some storm clouds. They're kind of off in the distance, but you see this big storm starting to build up, and you're like, ooh boy, might be a big thunderstorm coming in here, right? That's the way I would put it right now. And you're like, when the thunderstorm's way out there, you don't know if it's going to come and hit you, right? You don't know. Next thing you know, 20 minutes, 30 minutes later, it's going to be a big thunderstorm. It's going to be pouring on you. Or if that's just going to kind of stay out there and kind of drift away. That's the way I would put it right now. You look out there, there's thunderstorm clouds, no doubt about it. They have not quite reached us yet, but there's a potential of that, right? And the closer and closer those clouds get to us, the more and more we're going to be concerned. And I mean, you're just seeing stuff like this all over the place now at this point in time, right? BurgerFi filed for Chapter 11 bankruptcy protection on Tuesday, less than a month after it warned investors it had substantial doubt about its ability to continue to operate. It has resorted to bankruptcy to turn around their business. Red Lobster, Buca de Beppo, you've heard about these other ones doing that as well. This one came out in 2011, and it came out, when the economy was in a strengthening period, and now ultimately the company is going bankrupt, right? And they have $50 million of assets, $75 million of total debts. That's an ugly situation. No bueno in regards to that, right? Same store sales are down 13%. Oh my gosh. They have 162 restaurants. It's going to be a lot of people out of work, right? Now, some of those people are going to be able to find jobs elsewhere. No doubt about that, right? Some of those people won't. And so, a lot of franchisees are probably going to lose a lot of money on this. And so these are just all things to kind of consider. And at the end of the day, unemployment rates going up. You're seeing more and more stories about bankruptcies and these sorts of things, right? You're hearing about more and more potential loan losses. Like I said, it's a storm that's building up out there, and it's absolutely in sight now. It does not mean it's going to hit, but it is in sight.
We're able to start its cutting cycle with a 25 basis point cut, that would be very positive, that it didn't have to do what it thought was anything more substantial than that, because things are going pretty well and under control. Will the markets test the Fed and push the Fed? I mean, good day yesterday, but last week I started wondering whether the markets were going to push the Fed to a 50 basis point.
Well, they try. They try. And, there's a 50-50 chance that the markets are pricing in that we get a 50 basis point cut right now. So they certainly do try that. But the Fed is...
It's so frustrating. I'm trying not to go off. I'm really trying not to go off. I'm so frustrated, okay? Listen, the Fed should not need anybody to push them to a 50 basis point cut. We're at Fed funds 5.5. We have a CPI 2.5. Are you kidding me? You know how restrictive that is? It's insane. We've seen nothing but a correlation of inflation going down and down and down. Commodities have continued to go down. We see no strength there. At the end of the day, that sets up very well for the next 6 to 12 months when it comes to inflation numbers, right? Shelter's just less and less of an issue, especially as we go into 2025. You got everything there. You got all the ingredients to go and start making 50 basis point cuts. The fact that it would need the market to force its hand is ridiculous. But, unfortunately, we cannot trust the Federal Reserve. That is one thing we do know for sure. We cannot trust them. They've been continually wrong again and again and again. And they're wrong again, especially if they cut 25. It's going to be very frustrating.
Really easily pushed around. And, Joe, what we have right now is not a state of an emergency. We have somewhat weakening labor market. We have inflation that's under control. GDP is still growing 2%. So things are actually in check. So I'm hard pressed to think that the Fed is going to say, let's do 50 basis points. It's too good to be true,
though, Anastasia, isn't it?
Well, maybe it's slowing, so maybe it's not as good as it was once was.
But it's a very great place for the Fed to be.
Yeah, I think it's a very great place for the Fed to be. And, 50 basis points on the one hand could signal that they see something that the rest of the market participants don't. So in a way, I don't actually want to see the 50. But you could also make the case that, well, they do have a lot of room to cut. They probably have 250 basis points to work with to get back to neutral. So if they want to kickstart this cutting cycle with 50, that's fine. But here's what I would say broadly for the markets. It's not 25 or 50 basis points that matters. What matters is that we are in the beginning of a rate cutting cycle that's likely to go on for some time, and it is already providing relief to various parts of the economy, not just the markets.
Yeah, but let's be very clear, and she brings up a great point there, but at the end of the day, it is a big signal difference between 25 and 50. You cut 50, it lets the market, it lets investors, it lets everybody know you're serious about cutting rates. You cut 25, little baby 25 cut with 5.25, 5.5 Fed funds, 2.5 CPI and going down, it won't be long before we see a 2% CPI and maybe even a 1%. Truflation's already in the ones when it comes to their inflation numbers. And so, sure, the Fed could start out with a 25, but that just signals you're uncertain. You don't really know what you're doing. Does the Fed really want to signal that? Or they want to signal, we know where we're going, we know what we're up to here, right? We're starting out with 50s. Let's get rolling here.
Economy. And if you look at the 6-month SOFR rate, for example, it was 5.4% a year ago. It's about 4.5% today. If you think about your floating rate loans that are based off of that, they're already adjusting lower. And so eventually this is going to boost demand for credit. And actually, I shouldn't say eventually, because it is already boosting demand for certain loans, for commercial and industrial loans, for example. So I think the knock-on effects from a rate cutting cycle, whether it starts with 25 or 50 basis points, that knock-on effect is going to be strong in the coming months.
Alrighty, next one up here. Brad Gerstner speaking about big tech rotations of money, where it's going.
And see you. It's good to be here. Good to be here. There were two moments, I think, today. The markets were a little rattled, and Jensen Huang was on the stage downstairs and just continued to talk about AI and the great demand that he's seeing. David Solomon, as I said, sat with us and said things in the economy look pretty good. You were sitting in on the Jensen conversation. It's now your biggest holding, isn't it?
It is. It is. I mean, as you know, really going all the way back to January 23, it's been among our biggest holdings. It is our biggest holding today. There's been a lot of concern over the last couple of months whether or not there's an AI air pocket. Satya and Sundar got on their calls and said it's more important to overinvest than underinvest at this moment in AI. But we heard a few things this week, Scott. Elon Musk and Sergey Brin down in L.A. earlier this week at the All-In summit both said that the pace of AI is faster than any other tech development they have seen in their lifetimes. Yesterday, Dario from Anthropic was here.
Yes, but that's not surprising. That's not surprising. And here's why. Listen, we've never been in a point in time where companies this large, this successful, with this much money had an opportunity for the next big technology and could invest into that heavily. That's why it's moving faster, right? Because the companies with the biggest pockets, Microsoft, right? OpenAI with all the money they always are raising, right? Obviously Meta, Google. You look at all these different companies that are investing so heavily into NVIDIA chips, these companies have the most money. They're doing the most. And so we've never really seen that. Like if you think about like the internet age, I mean, companies were little babies back then. So they were investing small amounts of money and they were raising capital for this thing called the internet. And we're going to have a website and do all these sorts of things. But it was small money. You didn't have big pockets coming in to really invest in that, right? It wasn't like, companies had tens of billions of dollars to just throw at new internet related stuff. That wasn't the way it worked, right? It was a very small investment compared to this AI chip investment. So that's why I think it's moving much faster, because these folks have so much money. It's ridiculous.
Scott from Microsoft was here saying that, demand is continuing to outstrip supply. We heard the same from Thomas Kurian. So when Jensen took the stage for NVIDIA this morning, he said nothing's changed. Of course, there was some concern about a Blackwell delay. He took that off the table. He said Blackwell is on target for Q4 ramping of and scaling of production. So I think that as we look at 2025, we're at about $5 a share for NVIDIA. It got as low as $100. That's 20 times earnings for the most important company in compute today. So I think that, people are starting to lean back in to some of this big tech ahead of the election.
Is that when you made it your largest position?
So here's the issue, right? I think if anybody's really educated on this space, no one's concerned with 2025 numbers for NVIDIA. Everybody should assume NVIDIA's numbers are going to be great for 2025. That's not the concern. The concern is 2026 and 2027 and how is demand looking there, especially if we have a weakening economy over the next year. And you have all these big tech spending every dollar, it seems, on these chips, right? Who's to say if their businesses start to see some real weakness that they might pull back on spending at the end of 2025 and in terms of their orders for 2026? That's very much a realistic possibility, right? If at that same time, around 2026, 2027, you start to get more, let's call it serious competition from AMD, okay, now we could actually talk about price compression and we could talk about margin compression for NVIDIA at that particular time. That's something, I don't think enough people are factoring into this whole story in regards to that. So that's what's going on with NVIDIA. It's not like, if anybody's concerned about 2025 numbers for NVIDIA, they just aren't very educated on the space. 2025 is going to be great for them. We've heard Meta, we've heard, all these companies have basically signaled that they're going to spend even more on the chips in 25 than in 24, right? But what about 26? That's where the question marks really come up, and that's why you see, NVIDIA stock having a tougher time, because people are thinking, especially in regards to growth stocks, they're not just thinking about the next quarter or the next month. They're also taking into account the next year, the next 2 years, the next 3 years.
During that disruption a little more than a month ago?
We added a bunch to our position, almost doubled the size of our position when it was disrupted earlier, in August. And again, it's been very volatile. I think we'll continue to be volatile while people await that print in Q4.
But how are you thinking about the return on investment, right? I mean, you alluded to...
Q4 is going to be great. Q4 guidance is going to be great. No question.
The concerns in the marketplace about all the money that's being spent, the CapEx up 40 or 50 or even more percent.
And that's why I said there's still a potential NVIDIA could hit, as I've said this entire, before we even, I think, went into this year, I said there's always a potential NVIDIA could hit that 150 to 200 range this year. And how it would get there is you get a risk on market, right? And simultaneously, you get those great numbers with a blowout guidance, and then everybody's going to be back on the NVIDIA train, right? But that still doesn't fix the question marks about 2026 and 2027. So it's something that has to be considered. And so all of a sudden it's like it's a major pump. Everybody gets in, everybody's excited to the moon. And then after that, you got the downfall.
Annual basis. At what point, though, do we really need to see the fruits of all of that cash?
A critical thing to remember is NVIDIA is not just in the business of generative AI. right? What Jensen has reminded us is that we're going to have to replace the $1 trillion of CPU-driven data centers. This is stuff that drives things like data processing, everyday workloads in these data centers. And so you have $1 trillion over the next 4 years of generative AI workloads that we're going to invest in, and $1 trillion of CPU replacement that we're going to invest in. And so I think you're seeing incredible returns. He said this morning, for every $1 invested by the hyperscalers, they get $5 out of the generative AI workloads. He also talked about data processing. He said for a company like Databricks, they can drive down the cost of data processing by 95%. Their operating costs on a certain workload goes from 20 million to 1 million. So I think this, the red herring about ROI here is one that Wall Street spends a lot of time thinking about. But when you look in the boardrooms of all the hyperscalers and the big enterprises, they're all leaning in and investing.
The other thing he talked about that I thought was pretty interesting was a lot of what we hear when folks talk bullishly about Apple. He talked about their installed base.
You got to understand, it's very easy to lean in and invest extremely aggressively. One, when you're in a very exciting cycle, right? The first few years of a new product, offering that's very exciting, right? Secondly, it's very easy to invest extremely heavily in something when what? Your stock price is going up, right? And if you look at pretty much all the big tech companies for basically the last 2 years, where's their stock gone? Up and up and up and up and up. And so their revenues have been looking great, their profitability's been looking great, and their stock prices have been looking great, right? And so at the end of the day, they can really spend as much as they really want on these AI chips in the short term, right? But if at some point, and let's say in 2025, those stocks start to go through a tougher time, I could tell you there's a high probability they'll pull back on spending, and you just see that consistently over time. You see that consistently. We every single time these stocks all of a sudden go through a period of drama, a period of down cycle, they stop to invest so heavily in different things they're up to, right? And they pull back on the spend. We saw that from a lot of these companies in 2022, right? We saw that from Amazon. They started watching their spend aggressively. We saw that with Meta, right? And look at Meta's spend 22 to 23. It was down, exponentially. And so this is just, some food for thought in regards to that.
Not only on the gaming side, but on now the supercomputing side as it relates to AI. And it got me thinking about the way people talk about Apple. It also goes to the question of moat versus first mover advantage, right? He implies that he thinks they have a moat because of that installed base.
Yes. Well, I mean, when you think about the stack, this is no longer a computer chip. Blackwell has 7 different chips in the system. The system is the entire data center. And so the advantage, we also talked about CUDA. A lot of people point to CUDA as a moat for NVIDIA. Mm-hmm. But he said 100%. CUDA is just the beginning of our moat. We have 350 libraries that sit on top of CUDA. These are things like CUDA-IO and CUDA-DN that are specific algorithms targeting things like data processing or image generation or things like recommender models. And so I think the width of the stack is one that is much greater than people think. And he said the only thing that really competes is Google's TPUs. And he actually gave a pretty good shout out for Google's TPUs this morning.
Okay, I don't know why they just cut it out there. Okay, so, NVIDIA's just, at the end of the day, NVIDIA is one of those stocks that I look at it and I say, it's a rather easy hold, I think, for the next 10 years. It's a hard hold for the next 10 months. That's what I'll say about that. Because in the next 10 months, we'll see. We'll see. There's a lot that's going to be very interesting and transpire in this next 10 months, right? We're obviously going to have the election. We're going to have the inauguration. We're going to have, do we get that recession in 2025 or not, right? We're going to have where do big tech stocks head at that particular time. I mean, there's going to be a lot. Then there's going to be questions about, okay, who's in office and what are the probabilities of getting certain things done versus not. There's a lot that's going to happen in this next 10 months. I can tell you that. So that's why I say it's a hard hold for the next 10 months. I think it's an easy hold for the next 10 years if you obviously want to be invested in NVIDIA, right? 3-stock lunch, Goldman Sachs, NVIDIA, Toll Brothers.
Goldman to buy. Let's ask CEO David Traynor. David, welcome to you. And what do you think about the stock here? Hi, Kelly. Yeah, Goldman Sachs is one of our favorite financials. Has been for a long time. Look, having been in Wall Street myself, Goldman was always the top of the pecking order. And their returns on capital, the return on equity, their profits have reflected that. And we continue to be constructive on this stock. We think it makes a lot of money, huge cash flow, and it's still relatively cheap.
Yeah, but my pushback against all the financials, Goldman Sachs, JP Morgan, all these guys, is if we are late cycle, which there's debate if we're a late cycle or medium cycle or still early cycle, right? If we're late cycle, these stocks are not the play, man. They're going to get destroyed over the next 2 years if we're actually late stage cycle, right? So that's just something, food for thought. Like, it'll be 2 years of a downdraft for a lot of these sorts of financials if we're truly late cycle here.
Let's move on to another one that has huge cash flow, makes a lot of money, and may or may not be relatively cheap. That would be NVIDIA. Its CEO Jensen Huang weighing in on the strong demand and supply shortage for NVIDIA's latest generation of chips, saying the scramble for his company's products has frustrated customers and raised tensions.
Demand is so great that delivery of our components and our technology and our infrastructure and software is really emotional for people because it directly affects their revenues, it directly affects their competitiveness. And so we probably have more emotional customers today and deservedly so. And you know, if we could fulfill everybody's needs, then the emotion would go away. But it's very emotional. It's really tense. We've got a lot of responsibility on our shoulder, and we're trying to do the best we can.
That sounds like a question, an observation that demand is outstripping their ability to supply. Is that a problem or an opportunity?
I think it's a little bit of both. I mean, there's an enormous amount of capital being allocated into the AI and the semiconductor space for this reason. And look, NVIDIA is a great company. High returns on capital. I mean, like 10 times what even Goldman Sachs is. I think NVIDIA is around 195%. But the expectations baked in the stock price have more than that baked in. I mean, when we run the numbers in our reverse discounted cash flow model, we just did a big case study on NVIDIA because it's a poster child for good company, bad stock. The stock price implies that the profit's going to be something in like 10 times bigger than Apple and Microsoft combined today. And the revenues will be bigger than the GDP of the UK. So, you know, we're talking about a stock that has all that good news priced into it. This is not new news. I mean, NVIDIA has become a very crowded and popular trade. I don't think investors should be surprised to think that, oh, maybe all the good news is priced in. And as a result, we called the top in this stock a couple of weeks ago. And so far, that's turned out to be a really good call. We think on the margin, this stock has got a lot more downside risk.
So that's a sell.
Yes.
All right.
It's almost a short, but I don't know if you would dare with a name like NVIDIA. Let's move along to Toll Brothers, David, which is on the decline today, actually, even with what's happened with this drop in mortgage rates. CEO Doug Yearley was weighing in on that. And
short? No, heck no. To short NVIDIA, crazy talk. Now, on the flip side, let's say the stock does have a blow off top at the end of the year. Let's say we go back risk on market. Let's say there's a scenario where Q4 numbers are great plus a blowout guidance, right? And everybody just goes 100% like full on, like NVIDIA, like got to be on the stock. Then going into 25, then you could maybe potentially look at some puts if you're assuming that, you know, 2026 numbers will be troubled, right? So I don't know, like that's a potential, but shorting, like, come on, man, there's better options out there.
it will have on housing affordability.
The builders have done so well with high rates, which no one thought they'd do.
Yes,
We've been sitting on 7 to 8% rates now for the last 2 years. And finally, they're in the low sixes with a feeling that they're going to get lower. And that's when the builders sell more houses because the affordability, all changes.
I wonder.
So everybody, he's like, you know, everybody assumed home builders were going to be screwed over the last couple of years. And he's 100% right. Everybody did, right? They weren't. Now everybody assumes home builders are going to be great for the next few years. Maybe they won't. Maybe people are going to be wrong again in regards to this, right? Remember, rates come down and unemployment picks up. You're going to have housing inventory pick up substantially. The more inventory that piles up in different markets, the more you'll end up having price compression. If home builders their numbers start getting hit, right? they're going to have to start trying to grab market share. When home builders start to try to grab market share, whether it's because of competing other home builders or whether it's because they're competing against existing homes, margins start to get hit, right? Margins start to get hit, it's a whole mess. So, like, I think people are in danger if they just assume that home builders are like the play for the next couple of years. Like, maybe they are, but people just got this very wrong. Like, I don't know one person. I don't know, if we go back to 2022, I don't know one person, including the home builders themselves. If we went back to mid-2022, right? Let's go back a little over 2 years ago, that thought home builders were going to do phenomenal in the next 2 years. I don't know one person, including the CEOs of these home builders. And their business has been great, right? So who's to say we're not going to be wrong on the other side? That's just a little food for thought in regards to that.
Takes away their competitive edge, though, David. I mean, they've been doing buy downs. They've been able to be more competitive and you know, kind of entice the buyer in a way that the existing inventory could not. Maybe their competition heats up now. What would you do with the stock?
We like the stock. This is a buy-rated stock, and we've been really constructive on a bunch of home builders for a while. D.R. Horton's been one of our top focus list performers for a long time. NVR is one. I think Kelly and you and I talked about that one a long time ago. And, you know, look, the supply-demand outlook for these businesses is really strong. There's too little supply, and we need to build more homes. And the best builders, the really profitable companies, we think continue to be in a position to see continued profit growth, and their stocks are priced as if there will be no profit growth. Like, for example, with Toll Brothers, you're getting a free option on growth. The current stock price implies, right, the opposite kind of NVIDIA. With NVIDIA's stock price implies all this huge amount of growth. Toll Brothers implies zero profit growth from current levels. So we like the fact that it's profitable. It's seen great profit growth, yet the valuation implies there will be no profit growth. So that's good risk reward for us. We'd like that in this environment. And it's really getting increasingly difficult to find stocks we like in this good environment. I know Tyler always gives me a hard time because it's always sell, sell, sell. We did 2 out of 3 today, and we're glad that Toll Brothers made the list.
All right.
Yeah, Toll Brothers, one of those stocks, it looks cheap, right? You pull it up on 1000xstocks.com, you look at the valuation, like, dang, cheap stock, man. Great company, so well run. It was such a cheap stock. But the thing you got to factor in here is if we're late cycle on the housing cycle, right, which is a real possibility, keep in mind the housing market's been nothing but really up for how many years now? I mean, the housing market bottomed around 2010, 2011 in most markets, and here we are in 2014, about to go into 2015. The housing market's basically been in a massive uptrend for about 14, 15 years straight. Like, what if we do have a housing recession? And when I say housing recession, I'm talking about a home building housing recession, right? From, let's say, 2026 to 2028. Then you're going through 3 years of these home builders' numbers just going down and down and down and down and down. And just ugly, right? That would not be good. Doesn't mean that's going to happen, but that's why these sorts of stocks can't command huge PEs on them, because people understand that level of risk. And, you know, a stock like Toll would get cut in half way before the 3 years would go. Like, Toll would be cut in half in the first year of that, right? So let's say 2025 is moving along and the economy is getting worse. Let's say the labor market's getting worse, right? Unemployment rate keeps going up. Let's say Toll Brothers guidance isn't that good as we get to the back half of 2025 or something like that. The stock would get cut in half way before that. It'd go from $140 to $70, right? And then people might think it's a deal, and then it might go from 70 to 35, which is where it was prior to Rona, right? So it gets another 50% cut off that. So I don't know, just things to consider. Goldman Sachs CEO David Solomon says the economy is in pretty good shape.
Our host here at the Communicopia and Technology Conference. Thanks for having us, and thanks for being here with us.
Absolutely, Scott. Thank you for being here. Thanks for having your team here, and happy to spend some time with you today.
So we'll get to all things Communicopia in a minute. I do want to start, though, with the markets, because the banks have been the story over the last couple of days. Financials are down today. They're the worst sector out of the S&P. You've made some news this week. Your stock's gotten hit along with the others. You talked about trading revenue down 10%. You blamed a tough comp, but also a, quote, more challenging macro. What exactly are you seeing right now?
So the environment, the environment's actually okay, I would say, for bank activity in our business. There are places where it's been accelerating. I think we've seen a real acceleration in debt capital markets activity, some meaningful improvement in equity capital markets and M&A activity. In equity trading, pretty good. Fixed income, a little weaker. We obviously had a pretty volatile event in August that I think kept people on the sidelines a little bit as that sorted out, also with the August holiday. But one of our jobs is to try to communicate in the short term when we have opportunities to speak publicly about what's going on in the business quarter to quarter. If you step back a little bit, bank stocks have done incredibly well for the last 12 months. I think our stock, even today, since we sat here at this conference a year ago, I think our stock's up 43%. JP Morgan up similarly. So the stock's about a very, very big move. And the forward expectation, I think, is a little bit softer based on the commentary you saw at the Barclays conference in New York.
Sure.
But, still it's actually a pretty benign environment for activities. I wouldn't call it an A+ environment, but a pretty benign environment. And we're seeing an acceleration of activity, particularly on the banking side, which is quite encouraging.
The more challenging macro that you cited, do you see that persisting?
I was speaking when I spoke at Barclays. You're taking a soundbite out of my comments in Barclays. I said a more challenging macro environment in August, referring specifically to that August volatility.
Has that fully passed? Or do you expect more volatility?
Look, there's a lot going on in the world. We've got elections that obviously the result of which will have impacts on how people think about policy going forward. But no, that was an event, at that moment in time. I think generally speaking, the economy is still in pretty good shape. I think we're going to get a couple of interest rate cuts here that has been widely, telegraphed at this point in time. And so, base case, I can point to things that are slowing a little. There's some consumer, spots, you've heard it through earnings, et cetera, where there's a little bit of softness. But generally, I think the economy is in pretty good shape. And my base case is we're going to continue to chug along through the fall, with a lot of attention to the news, whether political, geopolitical.
So in regards to the economy, Goldman Sachs, not a good one to listen to. I'm just going to be completely honest with you guys. JP Morgan, I would say very good company to listen to in regards to understanding how the economy is doing or not, right? Even Bank of America, I think is a good one to listen to in terms of if you want to know what's going on with the actual economy. Ally Financial, I think is a pretty good one. Goldman Sachs, no. Why? Goldman Sachs isn't dealing with the average consumer out there. Goldman Sachs is dealing with big corporations. Goldman Sachs is dealing with high net worth individuals. Goldman Sachs is dealing with pension funds, other big investment funds. These folks they're not really attached to the economy, right? And so they're not really getting the sort of data that these other financial institutions, I think, get a lot more. And so I would never look at Goldman Sachs and say they're a great one to listen to in terms of if they feel the economy is great, that means the economy is great. And if they say the economy is bad, that means the economy is bad. I would trust JP Morgan any day of the week in regards to kind of like Jamie Dimon comments over David Solomon in regards to the economy. In regards to the capital markets, the stock market, fixed income, bond market, things like that, I think that's somewhere you could look at somewhere like Goldman Sachs and take what they say as, a high level of importance. But the economy, no.
Or otherwise.
Are you still in the soft landing camp then?
I'm still in the soft landing camp. Yes, I'm still in the soft landing camp. I think that is the most likely scenario. I can't tell you that there can't be a disruption or something that can set that off. But I think we've navigated to this point where the likely scenario is we navigate with a soft landing. But certainly, got to continue to watch consumer behavior, continue to watch inflation indicators will put more pressure on consumers. We've made real progress on inflation, but we'll watch the data and we'll see how things unfold through the fall.
Alrighty, appreciate you guys joining me as always. Once again, I got that brand new workshop for you guys. That's pinned comment down there if you want access to that. Runs over stocks to buy now for 2025, how to position your portfolio, all those sorts of things, get you a little motivated in that one as well. If you want access to that, will be the pinned comment down there. Much love and have a great day.